Treasury bills, T-bills, are the bedrock of the global financial system, representing a promise by the government to pay back borrowed money. Their history is a fascinating evolution from wartime desperation to the world's risk-free benchmark. Before the official T-bill existed, the U.S. Treasury relied on longer-term bonds or short-term certificates of indebtedness. These were cumbersome because they carried fixed interest rates. If the market rate changed between the time the government announced the certificate and the time it issued it, the sale could fail. The modern T-bill was born out of a need for flexibility. In 1929, Treasury Secretary Andrew Mellon sought a way to borrow money more efficiently. The innovation: instead of a fixed interest rate, T-bills were sold at a discount to face value. The mechanism: investors bid on the bills. The difference between the purchase price and the $1,000 face value became the investor's interest. Why it worked: this allowed the market rather than the government to determine the interest rate in real time. During World War II, the government needed to borrow massive amounts of money to fund the war effort. To keep borrowing costs low, the Federal Reserve pegged interest rates. T-bills were held at a fixed rate of 0.75%. This meant the Fed would buy any bills that the private market didn't want, effectively printing money to keep rates down. This ended with the Treasury-Fed Accord of 1951, which gave the Federal Reserve independence to set interest rates based on the economy rather than the government's budget needs. Historically, T-bills were physical pieces of paper. In 1976, the Treasury began transitioning to book entry form. Physical paper bills were phased out in favor of electronic records. This made the market much more liquid and secure, as you could no longer lose a T-bill in the mail. Today, T-bills are considered the world's safest asset. Because they are backed by the full faith and credit of the U.S. government, which has the power to tax and print currency, the return on a T-bill is mathematically treated as the risk-free rate of return, RF. This formula, CAPM, illustrates how every other investment in the world, from stocks to real estate, is priced based on how much better it performs compared to the humble T-bill. Would you like me to explain how the current T-bill auction process works, or perhaps help you calculate the effective yield on a specific bill? Modern T-bill auctions are a sophisticated Dutch auction process designed to ensure the government borrows at the lowest possible cost while offering transparency to investors. Treasury auctions occur in a specific cycle: announcement, bidding, results, issuance. The most important part of the process is the distinction between how you, the individual, and the big players, banks, bid. Non-competitive bidding: you just want the bill. You don't care about haggling over the rate. You are guaranteed to receive the full amount you asked for, up to $10 million. You agree to accept whatever yield is determined by the competitive bidders. Competitive bidding: they want a specific return. They specify the lowest yield they are willing to accept. If their ask is too high, they might get nothing. Primary dealers: a group of large banks like J.P. Morgan or Goldman Sachs are required to participate in every auction to ensure the government always finds buyers. The Treasury uses a single-price auction. After the bidding window closes, they first set aside enough T-bills to satisfy all non-competitive bids. They then work through the competitive bids, starting from the lowest yield, cheapest for the government, and moving up. The yield at which the last T-bill is sold is called the stop-out yield. Crucially, every single person, including the non-competitive bidders, gets that same stop-out yield. Calculating the math: T-bill yield. Because T-bills don't pay coupons, regular interest checks, the math is different from a standard bond. You buy it at a discount and it grows to its face value. There are two main ways to look at the return. A. The discount rate, the quote. This is how T-bills are usually quoted in the news. It uses a 360-day year, an old banking tradition. B. The investment yield, the reality. also known as the bond equivalent yield, BY. This tells you what you're actually earning relative to the money you spent, using a 365-day year. This is what you should use to compare a T-bill to a high-yield savings account. Example: you buy a $1,000 26-week, 182 days T-bill for $9.75. Discount: 25. Investment yield: 25 divided by 975 multiplied by 365 divided by 182, approximately 514%. The modern auction schedule: most T-bills follow a weekly rhythm. If you use treasurydirect.gov or a brokerage app, this is likely when you'll see them. For 4-week and 8-week T-bills, the announcement is on Tuesday, the auction day is Thursday, and the issue date is the following Tuesday. For 13-week and 26-week T-bills, announcement is Thursday, auction on Monday, and issue date the following Thursday. The 17-week T-bill has an announcement on Tuesday, auction on Wednesday, and issue date the following Tuesday. And for the 52-week T-bill, it's every 4 weeks for announcement, Tuesday for auction, and following Thursday for issue date. Would you like me to create a step-by-step guide on how to actually place a non-competitive bid on Treasury Direct, or perhaps compare T-bill returns to current CD rates? As we move through February 2026, the financial landscape has shifted following recent Federal Reserve interest rate cuts. This makes choosing between T-bills and certificates of deposit, CDs, a game of timing and taxes. Buying T-bills on Treasury Direct, a 5-step guide. The Treasury Direct website is famous for its vintage look, but it remains the only way to buy directly from the source without a middleman. Log in. Go to treasurydirect.gov and use your virtual keyboard to enter your password. Navigate to Buy Direct. Click the Buy Direct tab at the top of the page. Select Bills. Check the radio button for bills and click Submit. Choose your term. You will see a list of upcoming auctions, 4-week, 13-week, etc. Select the one you want. Enter purchase details. Enter the amount, minimum 100. Select your source of funds, your linked bank account. Schedule reinvestment, optional. You can set it to automatically buy another bill when this one matures for up to 2 years. When you buy a $1,000 T-bill, the Treasury doesn't take $1,000 from your bank. They only take the discounted price, e.g. $982. On the maturity date, they deposit the full $1,000 back into your account. Comparison: T-bills versus CDs, Feb 2026. Following the Fed's rate cuts in late 2025, yields are lower than they were a year ago, but still offer a healthy, real return above inflation. Current yield: T-bills by 3.30% to 3.65%, bank CDs I4.100% to 4.50%, top banks. Minimum: T-bills $100, CDs varies, $500 is $10,000. State local tax: T-bills exempt, tax-free, CDs fully taxable. Liquidity: T-bills highly liquid, can sell via broker. CDs hard, early withdrawal penalties. Safety: T-bills backed by U.S. government. CDs FDIC insured, up to $250K. The tax equivalent winner: while some CDs currently show a higher sticker yield, up to 4.50%, T-bills often win for people in high-tax states like New York or California. Because T-bill interest is exempt from state and local taxes, a 3.6% T-bill yield might actually put more money in your pocket than a 4.1% CD after taxes are filed. Which should you choose right now? Choose T-bills if you live in a high-tax state, want the absolute highest level of safety, or might need to sell the security before it matures. Choose CDs if you find a teaser rate at a credit union. Some are still hitting 4.5%, and you are certain you won't need that cash for the duration of the term. Would you like me to calculate the tax equivalent yield for you based on your specific state tax bracket to see which one actually pays more? To determine which investment actually puts more money in your pocket, we have to look at the tax equivalent yield. TEY. Since T-bills are exempt from state and local taxes, they have a hidden bonus that CDs lack. As of February 2026, the yields have stabilized after recent Fed adjustments. Here is the math for a resident of New York, a high-tax state. The real-time numbers: Feb. 2926, 13-week T-bill yield, 3.68% average 6-month CD rate, 4.05% top teaser CD rate, 4.50%. The tax equivalent calculation. If you live in NYC, your combined state and local tax rate could easily be around 10%. To find the tax equivalent yield, we use this formula. If you are a New Yorker, for a T-bill yielding 3.68%. The verdict: a T-bill at 3.68% is actually slightly better than a standard 4.05% CD because you don't lose that chunk to Albany and NYC. However, the teaser CD at 4.50% would still beat the T-bill by about 0.42%, even after taxes. Find your state-city tax bracket below to see what a 3.68% T-bill is actually worth compared to a taxable CD. Since rates have been trending slightly downward in early 2026, many investors are building a T-bill ladder. You buy $1,000 in 4-week, 8-week, 13-week, and 26-week bills. Every few weeks, one matures. If rates go up, you reinvest at the new higher rate. If you need cash, you just don't reinvest the next one that matures. Would you like me to build a sample ladder schedule for you based on a specific amount of money, or would you prefer to see the specific 2026 federal tax brackets to see your total tax hit? To finalize your 2026 financial strategy, let's look at your actual tax liability and how to deploy $10,000 into a T-bill ladder right now. For the 2026 tax year, the IRS has adjusted brackets for inflation. This is the tax hit you'll take on the interest from CDs, federal and state, versus T-bills, federal only. A single person actually pays $0 in federal tax on their first $1,100 of income. This strategy ensures that a portion of your money becomes liquid every month, allowing you to react if rates suddenly spike or if you need the cash. You divide your $10,000 into 4 rungs of $2,500 each. After the first 4 weeks, you have $2,500 coming due. If you need it for an emergency, you take it. If not, you roll it over. Once the ladder is fully built, after 6 months, you will have $2,500 maturing every 1.5 to 2 months like clockwork. If the Fed raises rates in June 2026, your next maturing rung will automatically capture that higher rate. Based on current yields of A3.65% for T-bills and A4.05% for CDs. If you earn $60K in NYC, your T-bill TEY is 4.8%. The T-bill is the winner over a standard CD. If you earn $60K in Florida, your TEY is 3.65%. The CD is the winner by about $40 a year per $10K. If you need the money just in case, T-bills win every time because you can sell them on the secondary market in 24 hours without the heavy early withdrawal penalties banks charge for CDs. Would you like me to show you exactly how to set up the auto roll feature on Treasury Direct so this ladder runs itself for the next 2 years? Setting up the auto roll reinvestment feature on Treasury Direct is the key to making your $10,000 ladder set and forget. In February 2026, the system allows you to schedule these reinvestments for a period of up to 2 years. Here is exactly how to do it. 1. Setting up auto roll, new purchase. When you are placing your initial order for each rung of your ladder, $2,500 each for the 4, 8, 13, and 26-week bills. On the Buy Direct page, after you enter your amount, $2,500, look for the section titled Schedule Reinvestments. In the box for Number of Reinvestments, enter the maximum allowed for that specific term.